Welcome to Chapter 19 in Intermediate Accounting 2. We are going to talk about share-based compensation in this video, and then at the end of the chapter, we are really going to dig into earnings per share. So let's go ahead and jump right in to understand what share-based compensation is. So we are looking at payments that are made to the employees in one way or another. This is going to award the employees. And the value of that award is based on the company that the employee works for. It's based on their stock price. How well is their stock performing? So we are going to look at the different ways that the employees can be compensated with these shares of that same company's stock through several different ways. So that's going to be stock awards, stock options, and stock appreciation rights. So the purpose of all of these is to help compensate the employees. It's another benefit, another reason that the employees want to start working there and they want to stay working there. So it also is going to motivate their performance in some cases. So sometimes this share-based compensation is tied to the performance of the employee. Other times it's tied to how long they have served the company. So the accounting objective, what we're here for, what we care about, is to measure the fair value of that compensation. We want to make sure that we can record it based on the fair value. So we want to expense that value out over the periods that the employees provide the services. So this is similar to what we saw with the pensions. We want to make sure we're expensing it out while the employees are doing the work that was tied to this type of compensation. So first, we're going to see two different restricted stock plans. So this is incentive for ongoing employment. We want the employees to keep working there, and we have these restricted stock plans. So the two primary ones that we're going to look at in this video are restricted stock awards and restricted stock units. So let's go ahead and jump right into the restricted stock awards. So this is shares of the company's stock granted to employees as part of the compensation. So again, we are giving our employees some of the stock in our company that they're working for, and that allows them to have another type of compensation, which is always a positive as an employee. And I would recommend, if you see a company that you're considering working for and they offer some type of, stock reward, then yeah, take advantage of that. That definitely can be a benefit, especially if the company's doing well. So when we say restricted, it means the employees cannot sell or transfer the shares until the vesting conditions are met. So vesting is whenever the employee has the right to that benefit. So vesting may depend on time. It could depend on performance goals. It just depends on the agreement. The employees usually receive voting rights and dividends even before they are fully vested. That's under the restricted stock awards. So they have these awards in their name. They have these shares of stock in their name. And if there's dividends paid, then those shares will increase with those dividends. And if there are any opportunities to vote, they'll get to vote. So that's even before they are able to fully be vested in that. Now, if the employee leaves before they are vested, those shares are forfeited. So maybe all this is happening for them, but then if they leave the company for one reason or another, then they are going to lose all of those rights to those shares completely, all the dividends and everything that went along with those shares. The expense is going to be recognized over the vesting period. So even though they're not vested yet, we go ahead and start expensing it over the time that they are reaching that vested period. Then we get to restricted stock units. So very similar in a lot of ways, but this is a promise to deliver company shares in the future. The other one, they already had the shares, they just couldn't take them with them yet. So they were still getting the benefits from them. They still had their name on the shares in the beginning, even before they were vested. In this one, in the restricted stock units, they don't have the shares at all. Nothing is happening actively with the shares until they are fully vested. So they don't have any voting rights, they don't have any dividends until they are vested. Once they are vested, that's when the company issues the shares and the employee owns them. So it all happens at once. Whereas the other one, their name was on it, but they just couldn't sell it, basically. They couldn't run away with it until they were fully vested. In this one, they don't actually have the shares. The shares are not granted to them, no dividends or anything like that until they reach that vesting point. The fair value is measured at the grant date based on the market price of the stock. So we're going to look at examples of this going in just a little bit. Compensation expense is recognized over the vesting period, just like we saw with the stock awards, even though they don't have the right to these stocks at all before vesting. So our new company is Next Wave Tech. This is a cutting-edge technology and software development company. They are riding the next wave of innovation. All right, so this is going to be the company that we follow. So under its restricted stock unit plan, so this is the second one we looked at, the second example, Next Wave Tech grants RSUs, restricted stock units, representing 3 million of its $1 par common shares to certain key developers on January 1st, 2026. So it's 3 million shares. They are all $1 par common stock. The restricted stock units are subject to forfeiture if the employee is terminated within 3 years. That means it's a 3-year vesting period. The market price of Next Wave Tech's common stock on the grant date is $20 per share. So the total fair value of these restricted stock units, 3 million shares times $20 per share, we have $60 million. That is the fair value. So that $60 million, the fair value, is going to be recognized as compensation expense over that 3-year vesting period. So all we have to do is we take the $3 million times the $20 per share to get $60 million. Then we divide that by the 3 years of the vesting period, and they're going to expense out $20 million per year. So let's look at what that would look like. So we've got the $60 million divided by 3 years. We are going to show each year at December 31st, over these 3 years of vesting, we're going to show compensation expense for $20 million, and then we are going to show paid in capital restricted stock. So this is the equity section of the balance sheet of $20 million. So this is building up in the equity section, even though the employees do not have rights to it yet. But then once the 3 years pass, assuming all those employees did in fact stay for the whole vesting period, we are then going to show the whole $60 million. At this point, we have accumulated $60 million over the 3 years. We made that top entry 3 times. We are going to show that $60 million leaving the paid in capital restricted stock because it's not restricted anymore. And then we are going to show it move into our actual common stock. Well, remember, it was 3 million shares of $1 par common stock. So that would be 3 million in common stock. Then the extra, the 60 minus the par value, the 3 million, the extra 57 is going to go in paid in capital in excess of par. So now it's treated just like stock that was issued to any investor that would have purchased their stock on the stock exchange. So we have the 3 million times the $1 per share, and we got that 60 million from the $3 million shares, or 3 million shares at $20 a piece. The 57 is the difference between the two. That was the additional paid in capital.